Right now, whatever you earn, roughly a quarter to a third of it is being taken before you ever touch it. And I'd bet money you couldn't explain exactly where all of it goes or why. Not because you're not smart enough, because nobody ever actually sat down and explained it in plain language. So let's do that right now, properly. Start to finish, no jargon, no fluff. Let's start with the single most misunderstood part of the entire system, tax brackets. Most people think if you move into a higher tax bracket, your entire income suddenly gets taxed at that higher rate. That is false, and it's a genuinely expensive myth. People have turned down raises and promotions because they believed it. Here's how it actually works. The tax system is layered. In the US, for example, rates commonly sit around 10%, 12%, 22%, 24%, and up from there, depending on income. These exact numbers shift slightly year to year, so always check the current IRS brackets, but the structure stays the same. Each layer only taxes the portion of income that falls inside it. So if your income is high enough to reach the 24% bracket, you are not paying 24% on everything you earned. You're paying 10% on the first layer, 12% on the next layer, and so on, with 24% applying only to the sliver of income sitting in that top layer. It's stacked, not flat. The result? Your take-home pay never drops because you earned more. It literally cannot happen under this system. If someone tells you otherwise, they're wrong, and now you know it. Next, what is actually being taken out of your paycheck specifically? The first piece is federal income tax, the bracket system we just covered. This funds the federal government broadly. Defense, federal programs, infrastructure, all of it. The second piece is payroll tax, which covers Social Security and Medicare. In the US, this is currently a combined 7.65% taken directly off your paycheck, matched by your employer. This money doesn't go into a personal account with your name on it. It funds current retirees and current Medicare recipients, on the assumption that future workers will fund you later. It's a pay-it-forward system, not a personal savings account, and that surprises a lot of people the first time they hear it. The third piece, if you live somewhere with one, is state income tax. Some states charge it, some don't, and the rates and rules vary completely from state to state.
Beyond your paycheck, there are other taxes attached to specific actions. Sales tax when you buy things, property tax if you own real estate, capital gains tax if you sell an investment for more than you paid, and estate tax on money passed down after death. Different triggers, different moments, same general idea. The government takes a cut whenever money moves in a taxable way. Now, here's the part that actually saves you money if you understand it correctly. The difference between a deduction and a credit. People use these words interchangeably. They are not the same, and mixing them up costs people real money every year. A deduction reduces the income the government is allowed to tax in the first place. If you earn $60,000 and claim $5,000 in deductions, you get taxed as if you earned $55,000. You don't get that $5,000 directly, you just get taxed on a smaller number. A credit is stronger. It comes off your final tax bill directly, dollar for dollar. A $1,000 credit means your tax bill drops by exactly $1,000. No layers, no percentages. So, given the choice, credits are more valuable than deductions of the same size. Common deductions include mortgage interest and student loan interest. Common credits include the child tax credit, education credits, and credits tied to things like energy-efficient home upgrades. Both categories exist specifically to reduce what you owe. Most people just never learn which ones apply to their own situation and leave that money unclaimed every single year. Now, let's talk about refunds, because this is where a lot of people get the psychology completely backwards. A tax refund is not the government rewarding you. A refund means you overpaid throughout the year, and the government is returning your own money to you, months later with zero interest. If you consistently get a large refund, it usually means too much was withheld from your paycheck all year. Money that could have been sitting in your account the whole time, working for you instead of sitting with the government for free. The financially efficient outcome is not a big refund. It's landing close to zero both ways. You don't owe a large surprise bill, and you don't hand over an interest-free loan either. A refund isn't free money. It's a correction. If you're self-employed, freelance, or run a side business, the rules shift and get noticeably harder. No employer is withholding taxes for you automatically, so you're responsible for paying estimated taxes quarterly yourself. Miss that, and the IRS charges penalties on top of what you owe. You also pay self-employment tax, which covers both the employee and employer portions of Social Security and Medicare, since you're technically both in the eyes of the IRS. The upside is that you can deduct real business expenses, equipment, software, a portion of home office costs, mileage, so keeping detailed records isn't optional. It's how you keep more of what you earn. If there's one habit that makes all of this manageable, it's this. Track your income, receipts, and tax documents as the year happens, not in a scramble right before the deadline. A simple folder, digital or physical, where anything tax-related goes the moment you get it. And if your situation involves self-employment, investments, or property, a good tax professional usually saves you more money than they cost, simply by catching deductions and credits you'd otherwise miss. So here's the real answer to how taxes actually work. It's a layered system, not a flat one. Multiple different taxes hit your income from different angles. Deductions shrink what's taxable, credits shrink what you owe directly, and a refund just means the government held your money longer than it should have. None of this is random, and none of it's designed to stay a mystery to you specifically. It's just rarely explained in plain language. Now you have it. If this helped, subscribe for more of this. I'll see you in the next one.